I love Chapel Pointe, and I love the people at Chapel Pointe. And I think we got something special going here, folks. We really do. And it really takes the people from 1944 on, people who gave of themselves, who volunteered, who prayed, gave financially. These all built what we have today. In fact, I would say that even before the Alliance home was established, a legacy gift was given unbeknownst of what that was going to go. So Mrs. Bedford, who this building is named after, when Reverend Henry was trying to find her and she was already deceased, he found the executor of this mansion that we have over here. And basically he proclaimed what his mission was going to be. Needed a place for the aging Alliance folks at that point. And in her will, Mrs. Bedford didn't know this was going to happen, but in her will, she wanted this home, this mansion to go to such an establishment that Reverend Henry had in his mission and his thoughts. And isn't that great how that kind of came together? And so, you know, you got to look at prices, but back then, the mansion, there was a local lodge that was offering it for like, going to pay $40,000. So back then that was a lot of money. Okay, this is during World War II. But because of the will, he was offered $25,500 as a selling price. And so he went to town. He with God's blessing, he gave up his pastorate in Chambersburg and just started going around to all the churches. Western PA, Eastern PA, Northeastern. And even though we're talking about the state of the economy today, well, back then it was tough, right? During World War II, and yet people gave, but God grew that money to establish that first facility in the great mansion. And isn't that a great story, the beginnings of a place? And you know, a lot of places start off great like that, but somehow they dissipate. They don't keep up that original mission. I'm very thankful that we still have a strong Christian faith underpinning here. It doesn't mean that everyone knows Christ in our facility, or employees have some struggles that they go through, but there's that strong leadership, that great culture that I enjoy very much, and it makes my job a lot easier. Now, part of my job is development, and of course, some of you may have known that I believe in the benevolence cause, and that's great. I appreciate it. As a matter of fact, if you ever put a check into a pink envelope and I see it in my mailbox, you've made my day. I mean, I'll be just like, that just makes, it makes me happy because people believe in this place and they believe in the cause of that. But I wanted to think about maybe even beyond our lives. Like when I pass away, what is the legacy that I'm going to leave? You know, is it just to my children, or is there some cause that can be a great cause for the kingdom of God, right? And I believe that Chapel Pointe, as we keep moving through the 21st century here, I believe that each of us just think about that your gift when you pass away could keep on giving, because that's what's happened in Chapel Pointe's history. Okay, people gave of themselves and they thought ahead. And I've had friends who have passed away here who left great amounts to this establishment, and I praise God for that. That's a great connection that we have. So I think I've probably spoken enough. The president of Orchard Alliance will be speaking of the state of the economy. I enjoy hearing that. Thank you very much.
Thank you. I just am delighted to be here. My name is Scott Kuby, and I am the president of Orchard Alliance, which is an organization that's part of the Christian Missionary Alliance, along with Chapel Pointe and some affiliations there. And so we're just family talking about the economy today, and I am really delighted to do this. A little bit about who we are as an organization and a little bit about me before we jump right in. Orchard Alliance serves the Alliance family where faith and finance meet. So we are a financial services. We do deposits. We take on trust. We help people with estate plans. So like what Jonathan was just talking about. And really all of that gets personified most directly in our relationship, which has been a long one with Chapel Pointe, in Clem, who I think most of you know and we'll hear from a little bit later today as well. And so this is a group of organizations. Some of what we do with our deposits is we go out and help churches that are starting up both in Pennsylvania and all around the US so that they can expand, buy their first building, buy a new building, make big modifications to some ways that can really serve their community in order to bring all of Jesus to all the world. And so that's just a super quick summary of that. I want to give you a quick sense of my bio here in the eyes of my 8-year-old son. So he's the guy in the middle with the 2 fingers up there down at the bottom. And this is his picture that he drew of me. And it was pretty accurate in the sense that, first of all, I have an overly large right ear. That's not actually physically true, but he drew it that way. And I took that to mean I listened to him about half the time. He wrote Orchard Alliance on the shirt, which means I must wear that apparel way, way too often because that's why I didn't today, just in order to try to break that string. And the most important thing about me, because it's the only other word on there, is ring, and that he's married to my mom. Beyond that, I used to serve as an investment strategist for really since the mid-90s, working on markets and doing communication about what's going on in the markets and figuring out how to help people, especially investors who had a financial planner that we worked with, allocate their investment portfolios. And so this is the first time I've got to do this as president of Orchard Alliance. It is not the first time I've done an economic update in my life by any stretch on that. So I'm going to sneak back before we jump in and give you 3 quick disclosures or comments about how to as we go through this presentation. First of all, there are going to be a couple charts on the that are going to be hard to read some of the data points, but we'll mostly be looking at the colors or the larger trends. So if you can't read something, it was a chart that illustrated what I wanted to share with you, and it just may have had more information than was exactly necessary. The second is some of you probably are prone to complain about how accurate the people who predict the weather are. As far as economists and financial predictors, the weather forecasters are geniuses. They are way more accurate than we are almost all the time. So take that, and if we were as accurate as the weather people were, it would be astounding. You'd still complain about us, and you'd still complain about the weather people. But I just want you to know that this is a very hard thing to do. We'll actually start out our first slide with that. The other one that I will tell you is if you ever get in a position where you have to do one of these presentations, the best way to sound really, really smart is to be negative. It is easy to sort of, oh, this is a problem. This is something that could hurt the economy. This could push it down. And you know what? That you start to sound smart and you start to scare or get people worried. But I'm going to tell you that when you start to look back at how the world has performed, think of all the crises that have occurred during your lifetime. Wars, Cuban Missile Crisis, Vietnam War, the Nixon presidency. That was a joke. As well as all the different other pieces, the Cold War, all the different factors, the financial crisis, COVID. And yet the system continues to be very resilient. And so one of the key things I always want you to know is that at base assumption, we should be optimistic about how things have gone, because if you look back historically, the optimistic case has also always been the most realistic case. And that's what we're going to see a lot in this data as well. Now, I shared some points about weather forecasters being geniuses compared to us. This is the economy, and I'm a data point short because they just released the next data, the most recent data on this morning. And what it said is that the US economy grew 3.3%, which is well above normal growth last year. Economists had predicted at the start, the consensus was that it would grow at 0.2%. and that it would do so with at least with a recession that would occur during the year because of the impact of interest rate increases. So they missed if that's effectively in weather terms, predicting it was going to be 75 or 80, or well, probably in this case, predicting it was going to be 35 or 40, and it ended up 75 or 80. It's very hard to predict what's going on within the economic situation. But the fact of it is, last year we had a very, very strong year within the economy, and the economy is coming in very good shape. Unemployment is down below 4%, which is a very high, healthy level of unemployment. And we are really in a very strong situation economically within the US. Now, a lot of things contributed to that, and we'll look at those very, very specifically. But one of them we wanted to hit on is that there is one person who did more to keep the economy strong last year than anyone else. And I don't know. I might be able to hear a shout out on that, but does anybody have any guesses on who that would be? She has a boyfriend who plays football. That's my hint.
Oh.
Taylor Swift is a very good guess. I want you to know that was one very easy hint. I just want to state that for the record, though. So Taylor Swift, her tour, the Eras tour, had massive economic impact. They did a number I'm just going to give a couple stories on this. So she filled up football stadiums multiple times in cities for the concerts. And people were flying in. So in the concerts, I think she did a couple of them in Cincinnati, was one spot on the tour. And they estimated that the impact of the tour on the economy just in the Cincinnati area for this was $48 million. If you're trying to think about, gosh, I'd like to get to see Taylor when she goes to Australia, there are actually none of them in New Zealand, no concerts there. So Air New Zealand had to add 14 more flights to 3,000 people from New Zealand that wanted to fly to Australia in order to see Taylor Swift concerts. And not to be outdone on this, there we go. Where did Taylor go? Oh, Taylor disappeared for a second. The concerts grossed over $1 billion. Hotels were record. I talked about the flights being added, and she wasn't short on her generosity, which is a key theme for us as an organization that really is a stewardship and generosity ministry. Is she gave $100,000 to all 50 of the truck drivers who drove the concert materials. She had a huge impact, and that seemed to keep on spilling all over the economy. And so Taylor Swift, plus a lot of other things, really caused the U.S. economy to be, frankly, quite strong compared to what we were expecting. Now, this chart is one of those that's got all sorts of different colors on it. It's really cute if you'd like to design really colorful charts. I want to focus on a couple things. So the first of all, the big dotted line that's up at the top, that starts at the top and then kind of drills down into pink, that's the level of inflation within the U.S. And what we've seen is that on a quarterly basis, a monthly basis here, the overall level of inflation in the U.S. is declining quite rapidly. So we had periods of time where back in 2022, if you look at that chart, we were up at 8.5%, even 9% inflation. That's really terrifyingly high. On the other side of it, though, we have really seen some big declines. Where are those declines coming? Well, one of them is on the gas tank. So the orange bars, when you look at those orange bars, especially when it peaked, you see that orange section that's at the top, it was adding a lot of inflation to the overall system. Energy prices were skyrocketing. But what we've seen in the last basically over 2023, is energy prices have started to decline instead of rise. That's been very positive. If you look at the next one, the green one, which is food, those green bars, whatever the numbers are, is important, but not that important. They've started to shrink. Food prices are not going up as fast as they used to. We've also seen declining in new and used car prices, there's a huge surge in car demand during the pandemic because people either didn't like carpooling for some reason, or they also moved to areas that were just more car intensive. And there was a huge surge of demand that pushed prices up. That has a lot of effect on inflation, but that's basically gone now as well as some of the pandemic industries like airlines and other pieces. So when you take the sum total of it, what we've seen is a very large decline in overall inflation, and that looks set to continue in 2024. It won't continue to decline at that rate, but we could see some ratings either in the low threes or even into the low to mid twos or high 2% range. The Fed has a target of 2%, but this is good news and very positive overall for the economy. Now, one of the things that really is likely to be something that you hear a lot about in the news that also affects inflation is what they call AI, or artificial intelligence. And that is a way that you can do. So for example, if I'd wanted to, I could have probably put this whole presentation together and just said, hey, here are some of the points I want to put together. Make me a presentation. I didn't do that because I don't like to edit the other stuff, and I wanted to make sure we hit the exact right points. But the point is, you can start to push things into like a search engine like Google, but you go up to an AI system and it'll write articles for you. It'll write posts for you. It'll give you, oh, I want a picture that looks like this, and it'll give you 12 of them to look at and say, no, these are too grumpy. I want something a little happier, or some of the people to be a little bit older. And it will give you ideas on how to do that. And so what we expect us to see is to actually start to see some small boost in worker productivity, where people will start to use this and be able to do certain things faster. Now, this really helps services, especially. Not as much manufacturing, but it will bring some overall productivity in services, which means that it will take fewer people to produce the same amount of stuff. And that's good, because that ultimately pushes inflation lower. Now, some of you worry, oh, if this gets too efficient, we're going to have a situation where lots and lots of people are going to lose their jobs. And there is some risk there will be job loss because of it. There is almost actually, in some ways, certainty that there will be job loss. But by being able to do this, it also creates new jobs and new opportunities and maintains the overall strength of the economy. And so our sense is that artificial intelligence, or AI, is going to be one of those things that starts to help productivity grow. Now, why is productivity important? Because that means that if people are being more productive, the economy can grow faster without necessarily having to see large wage increases, which means you don't get inflation. And so this is one of those things as we're looking apart, what are those things that are out there in the future that are likely to affect the world? AI is one of those things, and it's worth looking at. Don't get too excited, but also don't get too negative about it at the same time. Now, because of this decline in inflation, it is our expectation, and nearly everyone's, that the Federal Reserve will start to cut interest rates, which means savings accounts, ones that we offer, ones that other people offer, deposit accounts like the ones we have, banks, everywhere is going to see a decline in interest rates, especially on shorter term deposits in the next year. So the Federal Reserve sets interest rates, they control them, they raise them or lower them in order to speed up or to slow down the economy. When borrowing becomes more expensive, less people do it, and therefore the economy slows down. When they cut rates, it will tend to have an effect to speed up the economy. And that's what the anticipation is for next year. Right now, they're between 5.25% and 5.5%, which the economy has weathered very well. But we really would expect that economy, those rates to start to slow down the economy. In fact, we're seeing that with the lower inflation. We're seeing that in other areas as well. And so we expect the Fed to cut probably about anywhere from 0.75% to 1.25% in interest rates. The current expectation, the first rate cut is expected in May of this year. And so after that, there would be a fairly consistent succession of a quarter point cuts in interest rates. And so that means usually that's if you're a person who's looking to purchase a house or you're selling a house, this is really good news because that house is likely going to be cheaper to finance because rates are going to go down. If you're someone who's using credit cards to go get to the next location on the Taylor Swift concert tour, this is good news because you're going to pay a slightly lower rate on your credit card. If you're primarily a person who lives off the interest from your savings, this is going to be a little bit more challenging news, but it's going to mean that we expect the income levels from those types of accounts to decline in 2024. Now, one of the questions that people have often asked is, all right, if these things are going on, the economy's doing, people are starting to spend more money, is the consumer getting stretched, or are they starting to spend too much money and take on too much debt? And the answer on that is no, we're actually in pretty good shape. So this chart puts together the overall assets and liabilities. So everything above the black line at 0 is what households own. And everything below the black line at 0 is what households owe. So effectively, the debts are down below, the assets are up above. And what we see is that the debt level relative to overall disposable income, so it's based on how much money you have coming in, how much money you have the ability to spend. What it shows is the debt levels are about what they normally are. The only time that they've gotten a lot worse on this chart here is in that second column, which is 2007. That's effectively the financial crisis. That gives us an idea of when the consumer has got too much debt, what does that number look like? And we're not close to that number. The diamonds up above are where you see those diamond shapes. What they show is that overall the liabilities are under control. The asset levels for consumers are strong, and consumers as a whole look very, very healthy. Now, you may like this, you may not like this, but the fact is the United States is a debt-driven, to some degree, consumer society. And so as long as households are in a situation where they don't have too much debt and they have a decent situation for employment, odds are the economy is going to continue to be fairly strong, and that's what we're seeing so far. Now, there is one funny thing about consumers and how they interact with their spending. When you ask people how confident they are about the economy, they tell you they're very concerned. They're very worried. They think the country is going in the wrong direction. They tell you all these different views about their attitudes. And then you know what they do? They go out and spend more money because what their opinions are really are just expressions. In fact, what they become is often very heavily shaped by how well their political party is doing in the political situation, which has almost nothing to do with how much money they spend and whether they spend more or less. So while everybody was negative and concerned and worried about pieces and items going into the Christmas season because the consumer wasn't very confident, those surveys were just surveys. And when the votes that were counted were the ones that they used with their credit cards, with their checkbooks, debit cards, and cash. And what it showed is consumers spent a lot of money. They spent 6% more in December than they did the previous December, with huge gains in restaurants and bars and electronics and appliances, healthcare, auto parts, sporting goods, books, whatever it was, they spent a lot. The only two things that slowed down were furniture and home furnishings, which were actually a surge category during the pandemic. So if people themselves a new couch back 2 years ago, they don't need a new couch this year. And so therefore they feel they're not money there. And then gas stations, because fuel prices went down, and that causes the value of retail sales at gas stations to drop. The net of it is the consumer, when you follow the money and what they're doing overall with their assets, they are suggesting that they feel confident about their situation, confident about their ability to get jobs, and that things look, frankly, quite good at this point. Now, if you've been an investor for a longer time, you start to go, everything's a little bit too good. I start to worry about whether things might be overvalued in the markets. How much of the good news that we've talked about is already reflected in the markets? And the answer is some of it is, definitely a lot of it. And part of the reason is if markets don't reflect good news that's likely to occur, they're doing a bad job at being markets, because markets need to look at what's likely to happen, look forward and make estimations about how profits are going to be affected, and reflect that in current prices. This chart's a little bit hard to explain, but what it amounts to, if you just look at the purple line, is the S&P 500 is valued, its valuation is higher than 88% of the time since 1999, which means, if it was at 50%, that the market, as far as the overall price that you're paying for a dollar's worth of earnings or assets or cash flow or book value or sales or whatever the number you want to use is, if it was 50%, it would be that the price that you're paying for a dollar worth of those factors would be higher half the time and lower half the time, historically going back to 1999. Right here, it's been lower 12% of the time, or no, sorry, got that back. It's been lower 88% of the time and only higher 12% of the time. So markets doing what they do have reflected some of that good news. And that doesn't mean, so with all this good news, is the market going to go rally another 26% next year like it did last year? Probably not. It rallied a lot last year in part because the good news was there. We would still recommend staying invested, but don't expect expectations of 26% growth like we saw in the S&P 500 last year. One of the, before I wrap up with a couple other slides, one point I just wanted to add is, when you look at markets, you know that in the last 5 years, the market has moved over 18% every one of the calendar years. So stock markets go up between 8 to 10% a year on average. But in fact, they don't spend much time in average performance. So in 2023, as I mentioned, it was up 26.29%. But in 2022, it was down 18.11% because of concerns about inflation. The previous 3 years, it was up, with dropping some of the decimal points, 28, 18, and 31% going back, before it was down in 2018. And during those period of times, we saw some very severe declines during some of those positive years. So that was 2020, when it was at 18.4%, it actually went down over 20% because of COVID, and then rallied up because as things started to get better and the economy started opened up. So just to remember that you should, if you're investing in the stock market, which vast majority of people do and should, because they have longer term horizons or long enough horizons to do that, just remember it comes with some volatility. One of the things I've learned as I've measured is about half that volatility comes from changes in the economy and the companies, and the other half comes because investors get nervous or scared or worried or angry or whatever. And that really gets me to the last point that I wanted to share. So the best advice I've probably given over the decades of doing updates like this is keep your politics out of your portfolio. The number one thing that will get people jazzed up around the dinner table or at different conversations is what's going to happen politically. And I'll confess, I am trying to get off my, I'm a reformed, maybe semi-reformed political junkie. So I will admit fully that I get swayed by this stuff as well. I want you to look at these charts, but I don't pay much attention to the different pieces. This goes back to from 1946, so it's post-war just to 2020. The numbers wouldn't change a whole lot if I had an updated chart on this. This was the easiest one I could find in order to put this together. I want you to notice one big trend on this chart, forgetting who's higher or lower. During every political situation of who controls the presidency, who controls the Senate, who controls the House, if it's a split Congress, if they own all of the 3 branches, they own none of the 3 branches, all of those different scenarios, the stock market, on average, during those scenarios, goes up by significant dollars. Even if you look at the situation with the lowest, the 6.3%, compared to the 8.3% historical number, you'll notice that, would I rather have 6.3% or a much smaller number coming from fixed income? I'll take the 6.3%. And so regardless of the political environment, what we find is that the system works. You don't own, when you invest in the stock market, you don't own the political votes. You don't own the angry commentaries and speeches that occur in Congress. You own companies in a system country that has worked well, where they're able to keep those profits, to reinvest them, to engage with people in very positive ways and use their God-given creativity in order to help solve problems that people have, or to give them things they didn't even know were possible that will make their lives better. And so just remember that if you're texting somebody some article that you read that made you very upset or very happy when you read it, the important thing is not the article. The important thing is you have a phone that has more computer power than most of the computers that I've owned in my lifetime sitting in your hand. That is very, very impactful. And keep that in mind as we go through the political situation. Don't change your portfolio just because the person that you didn't want to get elected gets elected in 2024. So with that, I just want to summarize that up and take any questions if anybody has any. The economy looks actually even more likely to avoid recession, looks fairly strong. We expect inflation will continue to decline, allowing the Federal Reserve to cut rates. Households remain fairly strong. The market reflects some of that good news, so don't think you're going to get rich over the strong economy, because that's already reflected in the markets. And that core idea that over the long run, the system works has created just tremendous wealth, and it's an amazing thing to watch on a day-to-day basis. With that, Lindsay, if there are questions, I'd be glad to take them.
Would you ever invest in Bitcoin?
No, I personally, I would not. And there's a couple reasons for that. One, I'm not really sure what it is when you get down to it. And the harder I look, the less confident I understand what it is. The second, there is also some tremendous risk in investing in any cryptocurrency, including Bitcoin. And that is that any time that if it gets too big, the governments are very likely to go in and go, this is a terrible idea, and we're just going to get rid of it. And so those seem to be some risks there that are hard to understand. I also, there are two aspects of cryptocurrencies that have made me very concerned. One of them is just how they've been managed by the companies that offer them. Now, I think Bitcoin is much more legitimate than a lot of them, but there have been a number of trials and issues about lost coins, stealing things, and all this different aspects of it that make it less safe than a lot of the overall structures of regulation that we always sometimes go, I hate regulation, but sometimes regulation keeps us safe and is very, very important. In fact, most of the time it does. I don't know if those structures are particularly strong. The other thing I have some troubles with Bitcoin is it's going to be used for, sometimes it's used for things that might not have been the best activities. I mean, able to, for instance, certain criminal activities are more common because it's effectively untraceable transfers of money. And that just is something I don't have strong support of. So for various reasons, I don't think that Bitcoin is particularly attractive, but that's one person's opinion, and somebody else can have a totally different one as well from that. But I think there's a lot of hype and a lot of driven to trying to figure out, are you going to buy it? And if you're going to buy it, it's going to push the price up, and therefore I should buy it so I can sell it to you. That's not productive capitalism. That's just people trying to make money off of other people. That doesn't make the economy grow. It doesn't make the world a better place. And so that's one of the reasons we stay away from it.
I mean, should we become in our portfolio, the older that we get, don't we want to be pretty conservative because of the volatility?
Yeah, so this is one I have to caveat with. I don't know each of your particular situations, but in general, your ability to handle volatility declines the older you get. Not because you're older, but because you're closer to using the assets that you've saved up, and therefore you don't. If you might want to put, if you've got you're my situation at 56 and you're saving for retirement, you want a pretty considerable amount of your portfolio in stocks, because I've got a long time horizon. By the time I'm going to start using the money, the overall ability for the system to work is very positive. the older you get, you generally see some declines in that overall level of stock exposure. Now, one thing though I would say, and this gets back to generosity, is you may have some assets that are you looking to pass on to someone else. And therefore, or you know what, even if you're 82, you could actually live a considerable period of longer in life, and therefore have a horizon long enough for the ups and downs to start to work out in your favor to produce those as a wealth asset. So less stocks as you get older makes sense, but I don't know as no stocks do. And especially if you're going to leave money to kids or to charities, to Chapel Pointe, to anyone else at the end, you know what, you probably should have some more risk because you effectively have some surplus there. So that's something to work out with a financial planner, but you're 100% right. But I don't know if it means go to zero, because a lot of times people, you see people, I retired, I took all my money out of the stock market. You got a long life to live, and that productivity that the markets are very likely, not guaranteed, but very likely to give you is likely going to put you in a better financial position and ultimately a better life situation than if you'd taken it all out. And so there are different extremes to avoid, but your directional point is 100% correct.
All right, well, Scott can hear us. So can we give him a round of applause to say thank you for joining us today? One of the great things about working with Orchard Alliance is not only did we get to have Scott join us from afar via Zoom, but Clem Huber has been working with our residents here at Chapel Pointe for many years and has been a great partner, I know, with Jonathan and our whole team here at Chapel Pointe. So it's great to be continuing to develop this relationship with Orchard Alliance, who we trust. And because Clem is more local, he is here in person today. So I'm going to hand it over to him for just a few minutes to introduce himself.
Thank you. Good to be here and see everyone again. Some old friends. I didn't want to say old because I'm getting there myself, pushing a 7-0 number soon. But 16 years I've been coming to Chapel Pointe and meeting and making friends, and that's just been wonderful. I'm here. In my title is gift and estate design consultant. And for our role here, mostly I work with estate design, helping you know what you own, know where it's going to go, helping you make sure it's a comprehensive plan. A lot of times people understand what their last act on earth will be is in that last will and testament, right? That's your last act on earth, but it unfortunately doesn't control everything. So I help people understand, do you know where everything is going to go? And do you know where your document, the final signed document is at? And does the key people in your life know where that signed document is at? So I try to help you just understand all those pieces in my role of serving the folks here at Chapel Pointe. So I'll be coming to future lunch. What do you call learn and lunch and learn?
It'll be treats. It won't be
Treats,
full lunch.
maybe not be full lunch. Treats and learn down the road and share more specifics about some of these things, especially the pitfalls about that could be in your plan. Just trying to help you unearth that which may be embedded there that you're not realizing. So I help folks demystify this whole going home to heaven and what results here in Pennsylvania law when you're in heaven, and now what happens when you're gone. So God bless you. Glad to be here. Renew those old acquaintances again and get to make new ones. You have a good day. Thank you.